I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, October 24th. To see the full range of our publications and trading services, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. We're still in a bear market, but market action last week suggested that we're about to see the end of the bear sooner than the pessimists are predicting. This year, have we been faked out before? Of course we have. The consensus of Wall Street had been that the bear had bottomed in June. That was before we experienced a dreadful September. However, the month of October has been a lot kinder to investors. And at the same time, there's been increasing talk on Wall Street that, even though the Federal Reserve won't pivot in the fourth quarter of 2022, it will at least use November's 75 basis point interest rate hike as a staging area for reassessment and a pause. Regardless, last week was greatly encouraging, as the following chart shows. For the week, the major equity indices jumped as follows. The Dow plus 4.9%, the S&P 500 plus 4.7%, the NASDAQ plus 5.2%, the EAFE plus 1.7%. Despite the big cut in crude oil production by OPEC+, oil prices fell 0.5%. In the face of a looming recession that is stoking fears of energy demand destruction. The dynamic in the oil price is a reminder that policymakers and oil ministers can only do so much to influence oil prices. Global traders in the supply and demand equation are in the driver's seat with oil, which is a reminder that blaming high gasoline prices on any particular political party is electoral demagoguery. So, what will it take to sustain the stock market rally? The answer, lower inflation and concomitant easing by the Fed. We're already seeing signs that the economy is slowing, which in turn will cool inflation. Last week, we received housing sector data that revealed dramatic weakening. The adverse effects of rising interest rates have been the most sharply experienced in sectors of the market that are sensitive to interest rates, particularly housing, which is a bellwether for the overall economy. As the Federal Reserve tightens, mortgage rates in the U.S. have climbed higher, with a 30-year mortgage now hovering over 7%. Take a look at the following chart. The National Association of Home Builders, Wells Fargo Housing Market Index, the HMI, dropped 8 points to 38 in October, its 10th straight monthly decline. This reading is the lowest since August 2012, with the exception of the COVID breakout in the spring of 2020. This chart shows the NAHB index since January 1985 and how reading fluctuations coincide with recessionary conditions. The NAHB Wells Fargo HMI is based on a monthly survey of NAHB members, which asks respondents to rate current market conditions for the sale of new homes and in the next 6 months, as well as the traffic of prospective buyers of new homes. A reading above 50 indicates that more builders view conditions as good rather than poor. As this chart shows, October's reading is strongly indicative of a recession. But on Wall Street, bad news often contains a silver lining. In the case of the latest NAHB index reading, this weakness in housing should soon manifest itself in lower shelter and rent cost components of the core consumer price index. These CPI components have been particularly hot. Take a look at this chart. A bullish sign would be for U.S. Treasury yields to peak and stabilize. Lower yields tend to support stock and bond markets, particularly the higher valuation and longer duration segments of the market, because they reflect lower discount rates and cheaper cost of capital. Historically, in the 12 months following a peak in yields, bond market returns on average have been positive by about 16%. Now let's take a look at the week ahead. In coming days, keep a close eye on the following economic reports. S&P Manufacturing and Services PMIs, Monday. S&P Case-Shiller Home Price Index Consumer Confidence, Tuesday. New home sales, Wednesday. Initial jobless claims and durable goods orders, Thursday. Personal Consumption Expenditures Price Index, PCE. Consumer spending and sentiment, inflation expectations, and pending home sales, Friday. The upshot? Stay patient. Barring a black swan in, say, Ukraine, the worst seems to be behind us. In the meantime, you should know that I'm holding a special investment town hall on November 1. Be on the lookout for an invitation. Well, that's it for now. Thanks so much for watching. And if you have any comments or questions, don't hesitate to send me an email at mailbag@investingdaily.com.